Hello and welcome to Trading 5 Talents. In today's video, I want to go over an idea that I've been thinking about during these last several months in this volatile market that we're experiencing. And it involves using vertical spreads with the wheel strategy. So I'm just calling it the vertical wheel just because that name seems to make sense. So just by way of overview, the wheel strategy involves selling a cash secured put in which we are reserving a set amount of cash to buy 100 shares of this stock if we are assigned this short put. So if we're not assigned, we simply keep the premium and then we move on to the next trade. If we are assigned, we still keep the premium, but now we have to purchase 100 shares of stock. But once we own those 100 shares of that particular stock, we can now sell covered calls or we can short calls. We can sell calls using our 100 shares as collateral. If the call strike price never goes in the money at expiration, then we can simply keep the premium and then we can sell another call for the following expiration. Or if it does get assigned, what happens is we now sell our shares at that assigned strike price of the short call, and then we're back to the first step, and we can now sell cash secured puts again. So that's the traditional wheel strategy. That's what we primarily trade here at Trading 5 Talents. So just taking a look again with the traditional wheel setup, we start with a short put, and we use this diagram to denote the short positions, which are underneath the horizontal white line, which is the price line. You can see the vertical dotted line. That is the current market price. So a short put, and then once we're assigned the stock, or we actually just own stock, we can now sell a short call. So that's just how the wheel setup is traditionally run. A lot of people start with a short put. Once they're assigned, they go to the short call. There are other people, other traders that may want to just outright buy 100 shares and start on the call side. Either way, it's going to end up in the same place because it is a wheel. Now, with the vertical wheel or using vertical spreads in conjunction with the wheel, this is what it would look like. We first use a short put vertical. And if you don't know what this is or you want more information about vertical spreads, then I'll leave a link to a video regarding vertical spread setups and how they can be used. But the idea here is still entering a spread trade for a credit made up of puts. So the short put, you can see the red flag at the bottom of the price line. That's the same as the cash secured put. The only thing we're doing differently here is we're adding or we're buying a put below that strike price. So that's the long put. Okay, so both of those combined makes a short put vertical. Once we own the stock or once we're assigned the stock, just like the wheel strategy, instead of selling a covered call or just selling a short call by itself, what we're going to do is now we're going to add a long call on that side as well. So it would look like this. We've got the short call, this bottom green flag. That's the traditional covered call. But now we're buying or we're going long on a call just above that short call strike price. So those combined together, that short call and the long call, that would be the short call vertical. It's also called a bear call spread or a call credit spread. So there's different names. But again, the video regarding vertical spreads that I have on my channel will explain all of that. Okay, so that's just an overview of the vertical wheel. But basically you have this. You have the short put vertical to start off. Let's just assume we're starting on the put side of the wheel. So we have a short put vertical. And the way that this would work then is we would enter the short put vertical. And if the price moves down sharply, especially in a volatile market like we're in now, if the price moves down sharply, what's going to happen? Well, first of all, the short put, just like a cash secured put, now has a risk of being assigned because it's approaching that short put strike price. But what happens to the long put that we purchased in our vertical? That's going to increase in value. So we can exit that long put for a profit. And then we are only left with the short put of our vertical. And that simply turns into our traditional cash secured put or our traditional short put. So we're still running the wheel. We still can get assigned on this strategy, but we are maximizing the amount of profit that we can make in sharp moves that go against us. So if we're selling a cash secured put, what we want the price to do is to go up. But if it moves down sharply against what we want it to do, we can profit with this short put vertical and still have a cash secured put. If it doesn't move against us, if it stays the same or moves up like we thought it would, then we're just going to collect the full premium of the short put vertical. Now, granted, it's not as much as just doing a cash put. So for some, this may not be a viable strategy. But again, it's just something I've been thinking about over these past few months in our current market conditions. So on the call side, let's say we are assigned shares, or let's say we just buy 100 shares of a stock. We now sell the short call vertical. Again, the short put vertical and the short call vertical, these are both entered for a credit. So these are credit spreads. Now, with a short call vertical, if the price moves up too quickly or very quickly, then the short call is now in danger of becoming assigned and we have to sell our 100 shares. But the long call that we purchased of this vertical now becomes very profitable. And so we can simply exit that long call for a profit, and it converts our short call of our vertical into just a traditional covered call. So again, we're still running the wheel, but now we're adding these long calls and long puts, depending on what side of the wheel you're trading, for added protection if the market moves against you. And like the short put vertical, the same thing with a short call vertical. If the price doesn't move against you, or if it just stays the same or doesn't move quick enough, you simply collect the full premium of the short call vertical. Again, it's going to be less than a traditional covered call, but still there will be a premium, or there will be a credit that you can still receive. Once you're assigned, then you simply start the process over again, just like the traditional wheel strategy. Okay, let's take a look at how this would work with AMD as an example. So you can see AMD's price right now is $86. If we go to trade and then trade options, July 29th is just a few days out. So we're going to go with the August 5th expiration. So we're going to do a put. We're going to start on the put side of the wheel, or the vertical wheel. So sell a put. Normally what we go for is about a 70% chance of profit. So you can see this 82 strike price is 69.94. That's pretty close to 70%. So if we were to use this particular strike price, the 82 strike, you could see that $267 would be gained if we just did a cash secured put on AMD. However, we're going to need $8,200 in cash collateral in order to put this trade on, because if it gets assigned, we have to purchase 100 shares of AMD at the $82 strike price. So let's just look at this. You can see $267, that's the bid price. So that's how much you would make. Now, with the vertical wheel, instead of selling just a cash secured put, the idea here is to sell a put credit spread, or it's also called a bull put spread. So what we would do is we'd still sell that same strike price, let's say the 82, but then we'd go over to buy a put, and now you can choose whatever strike you want. For me, what I've been thinking is just going about half of what premium I'm getting here. So if I'm getting about, let's just say we're getting about $270 from this put. So maybe about $135 we'd be willing to pay for the long put. So if we go down to find something around $135, so here the $77 put, we could choose that one. And so let's take a look and see what this looks like. You could see we'd still get $134 of credit if we let this go to expiration. But once again, we are going to be protected on the downside if AMD falls very quickly before expiration. So let's take a look at OptionsStrat, and then we can visualize approximately how much we could be making. Okay, here we are in OptionsStrat, and what I did is I just went up to build and chose the bull put spread, which is the same as the short put vertical, which is also the same as a put credit spread. So 3 different names, same setup. Your short, 1 strike, and then your long, another strike. And I entered in the same prices as I was showing you in my broker, Robinhood. So the 78 put was $1.33. That's the long. And then the short 82 put was $2.67. It had a total net credit of $134 if we let this thing go to expiration and it expired out of the money. However, that's not the idea with the vertical wheel. So the vertical wheel, what we want is we want this long leg of our vertical spreads to increase in value so that we can get out of them for a profit, and then we just leave our short leg on the table, and that just converts into either our cash secured put in this case, or our covered call, doing it on the call side. So let's take a look now at what happens with this long put in this AMD example. So remember, long 78 put, current price, up here it's showing $85.20. Now to put on this trade, technically you only need $400 to put on this trade, which is just the width of the strike prices times 100. But because we're going to be converting this 82 put into a cash secured put eventually, you actually do need the 8,200, which again is the 100 shares worth of money at the 82 strike price. So don't get fooled by that. You actually need the full cash secured put collateral to put on this trade. Okay, so we just want to take a look at the long put. So what I'm going to do is I'm going to click on this, and I'm just going to exclude it from all the calculations. And then we see this. So if you don't see this, you just see a graph, then just go down here at the bottom left, just press on or click on table, and then you can see this here versus a graph. All right, now current price here of AMD is in this horizontal dotted line. Obviously red is loss, green is gain. And as the price moves down, so you're moving down vertically, then the value of this long put is increasing. So you can see it's getting brighter and brighter green. If the value of AMD increases, you're going to see it lose money and it gets brighter and brighter red. So obviously we don't want to hold this all the way up until expiration, which is over here on the right. What we're looking for is these first few days of putting on this vertical wheel trade. So what we want to do is basically we're using it as insurance. If our prediction of AMD is wrong, again, we're predicting it to go up. That's why we're selling a cash secured put. But if it's wrong and it just drops down dramatically because of an announcement, because of just that the volatility and the fear that's in the market right now, then we can capitalize on that, as you can see right here. So let's say it drops down to $80. Even if we go out to next Monday, which is in 4 trading days, you can still profit $34. If it had a dramatic price drop tomorrow, up to $163, as long as everything else is equal. Okay, so that's the idea of this this vertical wheel, is to protect your trade if the price moves against you sharply and quickly. And in our market conditions that we've experienced recently, that happens quite a bit in a lot of stocks. Price movements are sharp, price movements are quick, and price movements on several stocks are very dramatic. Once the long put is exited for a profit, hopefully, then you simply keep your short put intact for a cash secured put. So you can gain this money on your long put, plus you gain the full credit of your cash secured put, which in this case was $267. So if you just did a cash secured put, $267 max profit. But if you did this this vertical wheel example, you could get potentially this $267 plus whatever you made on that long put trade. Let me include this price back in the calculations. So even if the long put expires worthless and you don't gain anything, you can still receive the $134 credit for putting on this short put vertical. So let's take a look at some of the advantages and disadvantages to the vertical wheel strategy. But before we go on, if you have any questions about the website that we were just at, that's OptionsStrat.com, and how I set everything up and some of the features from that website, then there's a video that I already made that gives a tutorial and a walkthrough for OptionsStrat.com. It's a really helpful tool if you want to test out some of your strategies and sort of predict where or how a trade might actually turn out. I'd highly recommend it. It's completely free, so I'll leave a link down in the description as well for that website. So let's look at some of the advantages of the vertical wheel. First of all, as we mentioned in our example, that you can really profit from the long leg if that short leg is challenged. That is, if the stock price is moving against what you predict it's going to move or where you predict it's going to move, then that long leg is going to be increasing in value. As that short leg gets challenged, the long leg increases in value, and then you can simply sell to close that long leg, and you can capture that profit. So that's the main advantage behind the vertical wheel. Also, another advantage is that this strategy would theoretically work great in very volatile environments. With volatile stocks, a volatile market, again, like we're in now with recession on the horizon, the geopolitical events, numerous Fed announcements, as well as the rate hikes, and also a lot of the earnings that are not going as many investors would like to see for some of these bigger companies. So that all affects the market. You can have pretty wild swings in sometimes what are traditionally stable stocks. So instead of just using the traditional wheel, then using the vertical wheel, a variation might be a wise play. So what are some of the disadvantages? Well, if you were right on your prediction of where the stock was going to move, then you're just going to collect less premium. So as we saw in our example, that premium was about half as what the traditional cash secured put would have been. Now, I'm not going to go through a whole, call side of the vertical wheel because it's going to behave just like the put side, except you're going to be using calls against shares that you own. But pretty much about half of the premium that you would collect from a traditional wheel is what you would collect on the vertical wheel if the trade goes in the direction that you think it's going to go. Again, the vertical wheel is just there for insurance and added protection if your prediction is dramatically wrong in a short period of time, which that leads us to the next disadvantage of the vertical wheel. There's a very short profit window because options decay over time. That's the theta decay. And that's what, we option sellers like to profit on. Usually that's why we're selling options. But here we're buying options in hopes that their value increases with these price swings. So there is a very short profit window. So if you're trading weeklies, for example, with the vertical wheel, if that profit doesn't come within the first 1, 2, 3 days, then it's going to have to move. The stock is going to have to move much more dramatically in order for you to profit on that long leg. So really, you're just looking for a strong move in the first few days of the long leg if you're trading weekly options. So just a very short profit window, which is a disadvantage. Thirdly, there's going to be more commissions if you're paying commissions because you're buying another option. You're adding another leg. Instead of just selling one put, now you're also buying a put. So that's going to double your commissions. Similarly, with the calls, now you're buying a call instead of just selling one. So if you have any questions about this strategy, then go ahead and leave a comment down below or catch me on Twitter at Trading5Talents. And if you're interested in following along of how I'm progressing using the wheel strategy in this volatile market, then go ahead and click on the subscribe button and turn on the notifications so you can catch all the updates. Until next time, trade wisely and take care.